Hello and welcome to the November 2024 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to my update. I'm your financial planner, Greg Sykora, presenting solo today. Today, I'm going to talk to you about an interesting topic, and that is real estate. I'm going to show you its performance as well as some charts of how much real estate has come down in price since it peaked in 2022. So let's get started. About 2 years ago, Mark and we started these monthly videos. And at the time, one of our first videos, we talked about our expectations for real estate. I think it was in our call of June of 2022. What we saw at the time was that there was a lot of downward pressure building on housing, and we did not recommend purchasing additional physical real estate, such as a rental, as an investment. We actually thought there was a strong chance that we'd see a much larger correction than what you see on this slide. What we didn't account for was the wild card of immigration. Immigration and continued low unemployment with no major recession that happened in Canada or the US. It basically kept housing prices from cratering since the initial large drop in 2022 caused by inflation. However, when looking at pricing, one thing most people miss when looking at this chart is the actual inflation effect. Although you could look at this chart and say from June of 2022, right around here, to now, the prices in the Niagara region, they look to be about flat. However, on a real return basis, you're actually down. That's because over that time frame, cumulative inflation was over 10%. So on a real return basis, which is nominal price return plus or minus inflation, you're actually down close to 30% from the 2022 peak to now. So I feel really bad for anyone who got into real estate or young people like me that just happened to get into the market at that time. There are definitely a lot of people right now who got in at the top and are certainly underwater. Again, here's another look at real estate, this time in the GTA. This combines everything from single family detached homes to condos. Toronto real estate is down 19.3% on a nominal basis from March of 2022 through to October of 2024, based on the Korea benchmark price performance chart on the screen. To put it plain and simple, real estate is a risky asset. Anything that can go down more than 20%, I consider it to be a risky asset class. And on a real return basis, again, this is more like a negative 30% return from 2022 peak to now, if you include inflation. And what about the smartest guys in the room? The big pension plans in Canada, the ones that we participate in, such as CPP or OMERS or the Ontario Teachers Pension Plan, even they got bitten for their real estate holdings. Pension plans hold a mix of residential and commercial real estate, such as office towers in Toronto or New York. So it's not only just the residential real estate. But if you look at the far right column, if you compare the 5-year returns to say the model portfolios that I built that many of you are in, the 5-year return for say our conservative model clients that have around 40% stocks or 60% bonds is around 5% return after fees. That's a balanced stock and bond portfolio, and that's doing better than a mixed real estate portfolio. That's the bottom line over the last 5 years. And here's what I think is going to happen. I think we're likely going to see for the next few years real estate prices in Niagara, Hamilton, Halton, GTA likely stay around their current price. So if you're considering adding real estate or buying real estate as an investment, you should probably think twice. I think if I think you're going to likely be much better served in a fully liquid investment portfolio that consists of stocks and bonds or a combination of both. You've got wage growth and you've got lower interest rates helping demand. But on the other hand, you've got a potential population decrease through negative net immigration. Plus, we've got the Trump effect to worry about. The Trump effect being, potential tariffs on Canadian imports, which increases inflation in the US for those goods. Now, those goods, if there's increased prices there, they're less likely to be in demand by US people, which, if there's less demand, then less imports going into the US. We're probably going to see potential higher unemployment, or we don't know. We don't really know what the effect is potentially going to be, as well as if we enter a trade war. So if we go tit for tat with the US and inflation spike, I think if we look at the positives and then we look at the negatives and we weigh it all out, we're probably going to be net neutral over the next couple of years. So I think if we're comparing real estate to, say, a stock and a bond portfolio, you're going to be much better served in a stock and bond portfolio than you would be in real estate. So with that, thank you so much for listening to my November update. I hope you found it entertaining, and I look forward to presenting my next monthly update to you at the end of the month of December. In the meantime, happy holidays. Take care.